Good morning and welcome back to Morning Markets from True Potential, Paul Durrans, Investment Director. We'd like to start by just saying we are saddened by the loss of Her Majesty the Queen Elizabeth II and send out our condolences to the royal family and to the citizens of the UK. We start this morning with looking back at global equities last week. We saw positive returns, and that was really led by the US outperforming all other markets. No real strong reason behind it. There was talks of just oversold conditions, the continuation of the peak inflation narrative, and firmer labour market data. Here in the UK, we saw positive returns, but the UK market lagged most global equities. That was just given the high weighting to energy. Energy sectors saw a little bit of weakness given the declines we saw in oil and gas prices following on from the lockdowns that we saw within China as they continue on with their zero COVID policy. European stocks performed well, and that was despite higher interest rates coming through on Thursday. The European Central Bank raised interest rates by 0.75%. This is a big increase in interest rates, and that's just to help fight inflation, which is currently at 9.1%, well above that 2% target. Higher interest rates makes it more expensive to take on debt for households and for corporates, and therefore should cool the economy and help bring down the inflation. In terms of what we saw in bond markets, in global government bonds sold off, particularly within UK gilts as the new Prime Minister announced an energy price cap. And we also saw weakness within US government bonds, and that was on the back of stronger economic data and also hawkish messages coming from US central bank policymakers. In terms of looking ahead this week and what we'll be watching out for, all eyes will be on Tuesday on the US inflation report. This is the final week before next week's US central bank meeting, where they'll decide the next and appropriate level of interest rates. So Tuesday we'll see the inflation readings. What's expected is inflation to fall actually from 8.5% to 8.1%. If that happens and we get wage growth data on Tuesday that's firmer, then the market's expecting another 0.75% increase in interest rates to make sure that inflation continues to trend towards that 2% target. So a very important week in terms of inflation. We'll also be looking at producer price inflation or index. That is the costs for companies or producers of goods, what they're paying for their inputs. So that feeds into the inflation narrative. We'll also get US retail sales, consumer sentiment, and industrial production numbers. So it's a very busy week in terms of economic data, and we'll keep you up to speed each day. In terms of economic data for the UK, this morning we had GDP numbers. So this is the measure used to measure economic growth. What we saw for the month of July was the UK expanded, growing at 0.2%, not quite as high as what was forecasted, but still a positive reading and better than what we saw in June, which was down 0.6%. In terms of what was the key positive contributor, well, that was coming from the service sector. Services make up around 70% of UK GDP, and it's been a real driving factor over the month of July with information and communication companies doing well as consumer-facing service businesses doing very well. In terms of what dragging on the numbers, what we can see in the chart is the industrial production numbers as well as construction. That's everything from us today. Thank you for listening, and we'll see you tomorrow.
If you're interested in taking your investing to the next level, or would like to know more about the options available to you when you retire, then download our free guides to ISAs and pensions. These are available in the video description below.